I help my clients manage complexity and adjust to the fact that the status quo isn't working anymore. That I work on small and mid-sized companies, performance improvement and turnaround across industries, but the underlying factor in all of my clients is that something isn't working. They're not as profitable as they need to be. Sales aren't where they need to be. The lender relationship isn't what it needs to be. The vendors don't like you. Management, something's wrong. So I'm going to talk a little bit about, from that standpoint, how to lay the groundwork for sustainable growth and just what sustainable growth is. I believe there are three keys to a robust growth plan, and I believe that these three have got to be in any plan before you move any further. Aspirational. What does your company stand for and what's the vision? If a company can tell you what it wants to be, you're on the right track. And if it can't, you really need to stop there. Then directional. Where are we heading? It's important to differentiate between the aspirational and the directional. Aspirational it's the big picture. And directional is really, this is where we're going. Then measurable. Can't stress this enough. What does success look like? How do we know when we got there? This is an iterative process. Every plan, and especially every growth plan, should be an iterative process. You get to a point and you start again. You continue to reinvent yourself. There is no there. It's about a continual process of reinvention that continues to move your organization forward. But you need to be able to measure where you're going. And you need to have some objective measures to make sure that you're on the right track, or that you're not. Not all growth is good. In fact, a lot of growth, and in the 5 years that I've had my firm, ACM Partners, we've advised 30-odd small and mid-sized businesses across industries. The overwhelming factor that led them to me was a very well-executed growth plan that grew top-line revenues but resulted in liquidity issues, profit underperformance, and a status quo that just wasn't acceptable. I would say of 30-odd, at least 20 of those of my clients fit that profile. These are companies that were growing, some of them that had grown substantially, but at some point, that growth became bad and it became counterproductive. To me, good growth is about increasing your value add. And Phil talked about this with his graphite story, which I love. You're in a commodity business, but you understand a way because you start doing the market research to understand how you can add more value to your customers. That's huge. Having a differentiated product or service. If you're in a commodity business, maybe it's a service offering, maybe it's an informational edge, but having some way to differentiate yourself. And then improved financial performance. Profitability should be going up. Positive working capital trends. Moderate use of debt. Blocking and tackling stuff, but this is what good growth looks like. Now let's talk about bad growth. Your value add is decreasing. Top line may be going up, but you're not as important to your customers. You're not differentiated. They don't know your name. They don't care if they order from you or someone else. Maybe you've got a level 1 selling problem where your sales department is a bunch of order takers and you are not that important to the people that are ordering from you. And your financial performance is worsening. Lower profitability, negative working capital trends, very heavy use of debt. If you're on the right side, if you're on the good growth side, keep going. When you're on the left side, you need to stop. You need to reassess where you're at. What happens and the path from underperformance to distress is when a company starts off in a good growth mindset, the growth turns into bad growth, and they decide what I need is more growth. That's how a good company goes to an underperforming company, goes to a distressed company. Funding growth is a big blind spot for small and mid-sized companies. it costs money to grow. That's okay. But planning for that cost and appreciating what the cost is going to be is crucial. Just as an industrial company, a manufacturer or distributor would not think of doubling in volume without first understanding, well, how many more shifts do I have? Do I have enough capacity in my machines? Just as a business services company wouldn't say, I can process 1,000 more orders. Do I have the manpower? Do I have the computing power? You need to, in a good, robust growth plan, you need to plan for how you're going to fund the level of growth you're thinking about. Aggressive growth targets, even when they're achieved, can severely deteriorate your financial performance when companies don't think about this. I looked at a company and I did it across 3 different business types: manufacturing, distribution, and business services. I took a company at a baseline revenue of $20 million in year 0 and grew it at 20% a year. So it gets to just under 50 million in year 5. And then I started looking at some of the things that I've seen in my advisory career about what can happen to profitability and what can happen to working capital when growth turns from good to bad. And this was not any one client that I've had, but very much drawing on my experience advising clients. And what I started to see was you can, in the EBITDA variance, you can see manufacturing especially, you can see a pretty substantial drop in profitability by dollar value in manufacturing. And for business services and distribution, it wouldn't be uncommon to see a decline in profitability by EBITDA margin, even though your dollar margin might be going up. Now, this is important. Too many times, companies that are in a growth mindset, they get away from that measurability aspect. They get away from how am I going to grade whether or not this growth is good. If EBITDA is going up every year, that doesn't mean you're a healthier company if your EBITDA margin is failing. It's about having objective benchmarks and grading against them. Working capital, to me, is an even starker example. Working capital for a manufacturing company growing at 20% a year over 5 years, it would not be uncommon for that working capital impact to be $9.2 million. You're going to have to fund that. That's net working capital. Where's that $9.2 million going to come from? Is it going to come from owners' equity? Are the owners willing to reduce shareholder distributions? Is it going to come from debt? Have you looked at your borrowing base calculation? Do you need a term loan? Do you need mezzanine financing? Are you going to need private equity backing? Understanding where that $9.2 million is going to come from is absolutely crucial to the sustainability and the achievability of your plan. Get away from manufacturing for a minute. For distribution, same growth profile, you're talking about $7.5 million. Again, same question though, but in distribution, you're talking about a lower profitability business. Business services is a little bit easier. Look, the hit looks to be about $5.3 million, and that's because business services companies generally don't have any inventory. So they have the ability to grow faster. But still, growth comes with costs. Growth comes with real, measurable cash costs. And understanding that, understanding the financial constraints that a business faces when it seeks to grow is crucial to targeting the right level of growth, measuring it, and hitting it. Because if you exceed the level of sustainable growth, you're growing your way into a problem. Yes?
A couple questions. One, this is The inherent assumption here is that it's organic growth, right? It's not growth back by.
That's absolutely right. Although I would say inorganic growth comes with a lot of its own issues. I've advised a lot of clients that are looking into add-on acquisitions or even bet the company acquisitions, or that are beginning to explore that option. And you shouldn't ignore the costs of buying a company. Smaller companies, you're talking about a debt finance transaction, generally speaking. That's going to come with carrying costs for the debt. You're going to have integration costs. There's no way around there being a cost to growth. And when management teams start to find workarounds for the cost to growth, that's where you get into problems. What's best, what's ideal that I've seen is leadership teams looking forthrightly and saying, we can grow this fast if we're willing to make these trade-offs. If we're willing to go a little further out on the risk curve, we can grow this fast. But understanding that, what's the mix between organic and inorganic growth that we're comfortable with? But it's not the case that you're going to get any growth that's going to be free.
No question. But you're saying that 100.
But in this example, this is all organic, yes.
Organic growth, supernormal growth over 5 years requires that level of capital in order to, working capital in order to sustain a healthy.
No, that's the natural working capital from a minor degradation in some of your working capital ratios and just the natural growth, and AR is going to be higher for a $50 million company than a $20 million company. Right. So the vast majority of this change is just the natural size of the working capital accounts is growing as your business is growing. But also, one of the things that you see with growth businesses, and 20% is supernormal growth. Let's not kid ourselves about that. One of the things you see about that is working capital management kind of falls to the wayside. If you're going to grow at 20% a year, it is going to take an extraordinary effort to make sure your days sales outstanding doesn't change, doesn't degrade, to make sure that your collection stays as sharp as it was when you were a $20 million company as when you're a $50 million company. You might be tempted to give better terms to get a bigger deal. Your salespeople are probably beating you up to absolutely do that. You might be tempted to hold just a little bit more inventory for that next big order. Those are the trends. So there's a little bit of that degradation built in there, but that's mostly just the law of large numbers that you're seeing. That was a great question. Having clear benchmarks for the return on investment you expect from a marketing campaign is absolutely crucial, because you can throw money down a black hole, or you can work with Phil and actually get your money's worth. Financial challenges. I got into, in the previous slide, talking about how EBITDA can really go down, and we got into the working capital a little bit too. I wanted to break this down into 4 buckets to get into a little bit more detail on that. Gross margins tend to decline during periods of high growth. Your sales team is out there pounding the pavement, and there's a tendency to push the envelope a little. There's a tendency to buy business, especially if there's an aggressive growth target. It's human nature. It takes a lot of effort to ensure that doesn't happen. And during periods of supernormal growth, it is very normal to see gross margins decline. Variable costs can get out of hand. Sales team compensation is a huge issue. You're compensating people on sales dollars, not gross profit dollars. You could be killing yourself. It can really hurt a lot of businesses. Understanding the fixed cost structure, understanding how to moderate these costs and progressively forecast what's my break-even point this year? What break-even point am I comfortable with next year? What kind of cost structure am I building such that I'm focused on my goal, but I also want to be just a little bit conservative, so I've got a cost structure that I can manage if I don't hit my goal. The last thing you want to do in a period of high growth is start building a cost structure for the business you're sure you're going to be 3 years from now. And then working capital. Again, this is all human nature. This isn't blaming companies, but this is what tends to happen because no organization is great at walking and chewing gum at the same time. And if you're growing quickly, these things tend to naturally follow. Working capital accounts, they degrade. You don't pay enough attention to your customers, collections go down a little bit. They get softer. Vendor terms get a little bit looser for the people you're paying. Unfortunately, your customers stretch you at the same time that you end up getting more tied to your customers. Inventory goes up. You're tying up more and more capital in your operations. Progressively, it's getting more and more expensive for every incremental dollar of revenue to run and operate your business. For privately held companies, understanding these costs is one of the key unexamined aspects of a growth strategy. Hands down. Yes?
Overshooting under fixed costs, you mean you invest too much in fixed costs?
Yes. So basically, you build a call center for the volume you're going to have 2 years from now because you've been growing at 25% a year for the last 2 years, so why wouldn't that continue? And it goes for another year, and then it falls, and you never use that call center. You build a plant that never gets beyond 30% utilization, those type of things. I like to say that at my core, what I am is a change agent. I walk into clients and prospects who understand that the status quo is no longer workable. And often, the status quo is no longer workable because complexity exploded. Complexity doesn't go up on a nice upwardly sloping curve. It increases in a step function. You were a $20 million company, or maybe you started as a $10 million company. You were fine. You're a $20 million company. You're a $40 million company. You're a $50 million company. And those step functions are what absolutely paralyze management teams. The operational complexity of going from one plant, one shift, to one plant, 3 shifts, to multiple plants, multiple shifts, multiple machines is huge. Yes?
So what's the method of doing that? You can staff the answer to that question, or you can create processes to help you do that as well, right?
That's absolutely right. And it's the answer is both. The mix is going to change, but the broader and more nuanced consultancy answer is you're never there. Abandon the idea of it stops now, we've got it fixed. If you're growing, if you're in business, your business is going to reinvent itself. One of my favorite stories about Ray Kroc, the founder of McDonald's, was when he was writing his biography, somewhere in it, he said, I don't know if McDonald's will be selling hamburgers in 50 years, and I don't care. I've built a great business. I love that story. McDonald's is still selling hamburgers 50 years from now. Maybe they've got some issues too, but he understood and appreciated that reinvention was going to be at the core. And it truly is. It's about continuing to provide value, continuing to climb the value chain, and continuing to be differentiated. Information technology is an enormous issue that companies face. And it explodes quickly. You go from your hosted email and really all you need is a help desk to all of a sudden you've got 50 people with laptops and that's a thing, and then you're implementing a CRM and then you're implementing an ERP, and it just keeps exploding upward. These are all, again, don't want to attack complexity. Complexity is It's a tool and it's a competitive moat. But it's also a trap for organizations that don't change, that don't upgrade their staff and their leadership team, that don't upgrade their processes. If you want to continue managing in a status quo manner, the way you managed a $10 million company is subpar for how you would manage a $20 million company. It's absolutely wrong for how you would manage a $40 million company. It's going to kill you if you're an $80 million company and you're still in that $10 million company mindset. That is why you often see a lot of churn in management teams as they hit that next step in complexity. That step function is often a signal that it's time to upgrade the team. It's time to upgrade the process. If you got surprised by the step, it's absolutely time. What you want to do is you want to keep anticipating. I know there's another step coming. I'm going to continue reinventing myself. I'm going to continue improving my financial performance so that I've got the right metrics dashboards, so that I am doing the right forecasting so I don't get surprised by next quarter's numbers. I'm going to continue with my strategic planning so that I've got a rolling 12-month view on what's around the corner, and I've got a rolling 5-year plan. I'm going to continue reinventing my sales and marketing so that I'm always ahead of the curve, so that I'm not the slide rule company that didn't see calculators coming. Key points. Sustainable growth is all about planning. It starts with a vision, but it must progress to how are we going to measure that? A growth plan that doesn't end in monthly or at least quarterly financial and operational variance analysis is a growth plan that is doomed. You've got to get to a point where you say, this is where we're going, this is why we're going there, this is how we're going to measure it. All growth is not created equally. You want growth that makes you better. Growth that makes you weaker will kill you if you keep doubling down on it. A good growth plan is going to address your funding needs. This is not an area where companies can put their head in the sand. Understanding there is a cost to growth. If you don't know what the cost is, you need to do some digging. You need advisory support. But there is a cost to any kind of growth. Understanding, appreciating, and figuring out how you're going to fund that cost is going to be crucial to making it happen. There's nothing wrong with saying, I'm a $20 million company now, I want to be a $100 million company. How long is it going to take to get there? What do you need to do to get there? That's the difference between having kind of a back of the envelope plan and a real robust plan that's sustainable and achievable. And then prepare for change. Growth is going to bring increasing complexity. You're going to need new partnerships. You're going to need new reporting, and you're probably going to change your leadership team at some point. Not necessarily everyone, but there's going to be churn. There's going to be the process of reinvention, and that's okay. That's natural.
Could you give an example of a company that was hurt by growth, or a case history?
Oh, absolutely. In 2012, I was brought on as an interim manager to work with a home remodeling company. And in 2012, the recovery, especially in the home remodeling industry, was still a little shaky. We didn't know that we had this much longer to go. And the pain of the recession was still fresh in everyone's mind. This business had figured out a multi-channel marketing strategy that was absolutely fantastic at making the phones ring. They had built a machine. They knew how to get leads, they knew how to sit those leads, and they sold once they got in front of people. They were very good at that. They went from $7 million in revenue in 2009 to about $17.5 million in 2011. And then the wheels fell off. And the reason the wheels fell off was that the cost structure that had built up over that time was so much at odds with the underlying profitability of the business that unfortunately, the owner had just spent himself into a hole and didn't realize it. So when I got brought in the end of April in 2012, the owner told me, I'm in trouble right now because we hit about 17.5 million in sales last year, and I think if we had hit 20, we'd be fine. And I'm learning, so I'm taking notes, but sometime that summer, I pointed out to him, I said, you know what, you said it was 20, and I'm not pointing fingers, but the number was actually 30. And the fact that you were that far off is why we're here right now. Unfortunately, that company was so far gone, that company liquidated. And I was there the day we turned off the lights. We had some private equity interest, but everything was so underwater and it was so far gone that there was not. To me, that stands out as the most vivid example in my professional experience of just rock star marketing gone awry. They just grew themselves right off the cliff.
Why do companies struggle with profitability when sales are going up? What causes that?
It gets back to every organization. This isn't unique to the for-profit sector. Has trouble walking and chewing gum at the same time. It's difficult. You get everyone motivated about doing this thing, and everyone's motivated around that to orient an organization towards sales. And also, let's think about the people that lead organizations. Generally speaking, leadership teams are staffed heavily with extroverts. A lot of extroverts came from sales. It's in the DNA of most leadership teams to focus on sales. It's fun. And unfortunately, if you don't take the punch bowl away, or at least moderate how much you drink, you get sick. And that's exactly what happens with growth organizations. It's fun to go from 50 to 100 million in sales, especially if you're going there fast. You get to talk to your friends at the club. You get written up in the press. It's a good time. And the business stories don't talk about your bottom line, especially when you're a private company. They talk about your top line. So you don't get as many hard questions on the ride up as maybe you should. And that's why problems start to build up.
That's a great point. That people are less likely to be asking you a question on the way up because everything looks rosy
Right.
at the start.
We should not ignore the fact that our economy has become increasingly pro-cyclical over the last 30 years. It's not a bad thing. There's nothing wrong with growth. But one of the downsides is as the advisory community, as the business press becomes increasingly pro-cyclical, there are fewer and fewer cynics to say, that's faster than you should grow. Why are you spending 25% of sales on marketing? That sounds a little high. You get fewer of those questions. And leadership finds itself in a bubble that's self-reinforcing. Again, it's human nature. It takes an act of will, and it takes a broad and deep network of advisors, trusted friends, a broad networking group that will kind of pull you out of that and say, you should think about this. I'm working with an organization right now. CFOs are very strong, great diagnosticians, but unfortunately, in the context of a private company, what you'll often find is a longtime CFO will diagnose you right off a cliff. Hey, this looks bad. We lost money this year. We're losing more this year. And they'll just keep telling you. And they won't stop you because they're an employee. And it's a mindset issue. Having a peer group for the highest level of leadership in an organization, an outside network, and again, that can be advisors that get brought in, it can be a Vistage group, but having a group that of someone who has the standing to say, no, this doesn't make sense, no, this needs to stop, is absolutely crucial. It's very difficult to have an underling in an organization tell you, no, this needs to stop, because it's just not the mindset. Gary, I know you had your hand up.
I was curious on how you, I mean, obviously part of what you work with is companies that are kind of on the downside. How do you communicate to companies the sort of, this too shall pass, and believing their own press, right? I mean, if things are going up, sales are doubling, on and on. Many, so part of it is where the CEO comes from, right? I always ask somebody, so our president, you know, all he wants is, you know, he thinks that we can grow better and it's going to be more important. I said, is he a sales guy? Right. Because if the president's a sales guy, sales is the most important. Operations and the supporting organization underneath it sort of becomes an expense. Yes. And an expense mindset, you know, you and I have talked about this a long time ago. An expense mindset is dangerous to a company because they treat things that are valuable, that have valuable asset-based infrastructure as an expense, and therefore they minimize it and it crumbles under a top line that is oppressive, becomes oppressive. So how do you help companies that are on the way, that believe their own press on the way up?
What I like to do is I ask, what's the goal? Where are you going? Is it, you know, are you a $50 million company that wants to be a $100 million company? Or are you a company with $8 million of equity value that wants to have $20 million of equity value? What are you trying to achieve? If your goal is to have more revenue forever, okay, but why? And when framed that way, most business owners and most leaders that I've met will concede, no, I want equity value to go up. We would like to do an ESOP one day. We would like to sell to a private equity firm. We're owned by a private equity firm and they're going to sell us in 4 years, so that's our mandate. Well, okay, if it's about maximizing equity value, are we doing that? And it can be very eye-opening to sit down with a leadership team and say, you've grown impressively over the last 3 years, and you've halved your equity value. I've had those conversations. It's a blow. It's like they've been punched in the face. But then you say, okay, we can pause here and start maximizing value and figure out what the right sustainable level of growth is that's going to continue to increase your value rather than just the kind of quick hit of top line growth. Again, nothing wrong with top line growth, but having the right mix of it in part of an overall approach to maximizing value is where most people want to be. It's just the bias is the fastest way to get there is to grow as fast as I possibly can, and that is not actually the fastest way to get there.
Dave, any other examples of a company growing into distress that you could share with us, or
sure.
Additional reasons?
I was advising a staffing company in an interesting niche in the staffing space this past fall. And I was working with the president of the company and the new CFO. They had a $60 million division, and it wasn't as profitable as it looked like it could be. And growth had kind of moderated. And I looked at the 160 clients they had had over the last year. I did a quintile analysis, and about 40% of that business was underwater. On a fully allocated cost basis, they were either losing money or making no money. So they would have been better off being a $36 million division instead of a $60 million division than being the $60 million division with almost $25 million of junk revenue. And I sat down and I walked the leadership team through where I was at, and I said, look, there are growth opportunities here, and I think other people on this team, because I was working on a team, could help you get there, but I see a roadmap to doubling profitability where you're at. And that, getting your head around that, getting a leadership team's head around that, getting all the stakeholders to say, wait a minute, so we can take where we're at now, and we don't need to be from 60 million to 80 million to have the profitability we want. We could have the profitability we want now. Well, then that changes your mindset of, what's my benchmark profitability going forward? Again, it's about reinvention. It's about changing the mindset of, you don't want someone to think they're in a 5% EBITDA margin business when they could be in a 10% EBITDA margin business because they haven't upgraded their processes. You want to point out to someone, no, your business could be twice as profitable as it is right now if you make these changes. It's about shifting from rule of thumb management to objective, data-driven management. That's what it's like to climb that ladder of complexity. Going from, I know my business, I've got my finger on the pulse. Well, maybe when it was a $10 million business, but at a $50 million business, it's next to impossible. You get to a point where you have to trust your numbers, you have to trust your analysis and your team, and when everything is flashing red, you change. You don't want to get to a point where everything's flashing red and you say, but I know that's wrong. Scott.
David, you've been talking a lot about the numbers and so forth. What about the psychological change? Are you able to help a CEO change the way he thinks? In other words, you have to think differently at 10 million. Do I want to be a CEO, or do I still want to bake cookies?
That question is crucial. And the psychological point gets back to leadership and being a change agent. I get brought in as an interim manager from time to time, generally a few times a year, and I'm always very candid with my clients. A big part of me being here as an interim manager is the signal. The unspoken message that we needed to change something radically. We brought in this guy whose goal is to work his way out of a job. You want to electrify a room full of downtrodden people, walk into a company that's not doing well and say, I want to leave here in 6 months because I worked my way out of a job because you don't need me anymore. Who here doesn't want me to be here in 6 months? Every hand is going to go up. But Scott, you're absolutely right. Getting that message, getting that mindset change, when the status quo isn't working, something's got to change. And if you can't identify and pull the lever or the levers necessary to make that change, you're spinning your wheels. A lot of it can be unspoken, a lot of it can be leadership, a lot of it can be example, a lot of it can be morale boosting, but you've got to get there and you've got to find that lever. I'm a big believer in large, symbolic, nonverbal messaging that gets it across in a very, very clear way. Yes?
So David, you're a consultant and you've talked to us about the risks of growth. And we've identified the fact that CEOs and leaders are extroverts and love top-line growth, and they lack maybe the goals of self-criticism and introspection. And so how can you advise, what would be an ideal role for you to advise this change agent CEO to take this $60 million business, change it into a very profitable $60 million business without going to 80? How can you provide them that support without saying, I'm going to sell you, $250,000 of consulting services, but I want to be your partner?
Yeah.
How do you do that? How do you become their helper without selling them this program of consulting services? Is that a good question?
No, that's a great question. I've advised 30, 35 clients in the time that I've had ACM Partners, and before that I worked for larger consulting firms. In my nearly 20-year career, I've probably advised 100 companies or been an employee at them. So I've seen a lot of companies in a lot of different phases of change. I wish more of my clients came to me early. I wish I had gotten the opportunity to do an assessment for everyone and they didn't need me for anything else, because someone else will. That's fine. The biggest thing is recognizing change is necessary and getting the expertise in the door. Good advisors, and I'll count myself among them, are more than happy to say, look, I'm going to help you out. I'm going to diagnose where you're at. I'm going to give you the roadmap. And if you've got the team, execute it. You know, we'll talk about quarterly checkups, monthly checkups if it's more than that, if it's further advanced than that. The reason companies need to bring someone like me in immediately is because they've hit a wall. They didn't see the wall coming. They hit the wall and they're stunned. I'd love it if they brought me in 6 months earlier, a year earlier, and said, you know, profitability is not where it needs to be before I've got a problem. Before my bank gives me a call and says, you have 3 options. You don't get to choose whether or not you're hiring someone. I'm just going to tell you which guys you can pick among. That's not where you want to be. So it's about management teams being proactive and getting there first. If you're not as profitable as you want to be and you've been growing, or a company that you're associated with that is in that position, that status quo isn't good. 2 years from now, that company could be a client of mine. I would much rather help every company that just would like to go from 5% margins to 8%. I'd love to have one of those years where I just help a bunch of them and am not the guy who has to shut down a division in 2 weeks because someone made a mistake 3 years ago and it was left unaddressed. So I don't need to sell 6-month interim management engagements. I do because some of my clients need that. I would be happy to sell a bunch of performance improvement engagements and help more CEOs work with that. What I've found, human nature being what it is, they don't tend to recognize they need performance improvement until they're well into distress. A technology website and company that I followed, or used to follow, GigaOm, recently failed. And I wrote a piece on it. They had raised $23 million in venture capital since 2006. They had a subscription model. They had made 3 acquisitions. And they burned through $23 million, more than, because when management shut it down, they recognized that they owed money to a bank, they owed money to their trade suppliers, so they'd burned well in excess of the $23 million. It's just interesting. You have to know where you're going, and you have to be able to measure that and make course corrections. There's nothing wrong with saying, I'm a design and manufacturing shop. I want my 40% EBITDA margin manufacturing business and my nice high margin design business, and that's who I am. That's fine. It's when organizations lose sight of who they are, what the goal is, and they just start going for it, but they forget what it is they're going for and how they're supposed to be measuring that they run into trouble.